we'll make a start, and then we can just talk you through how we'll run the webinar, and then that gives some colleagues a chance to join as they're coming on. So first of all, thank you so much for joining us. It's great to see so many people joining us for this webinar. So I'm Graeme Royce, I'm Chair of the Scottish Fiscal Commission, and I'm going to be talking through the presentation today, and I'm joined by my fellow Commissioner, Domenico Lombardi, who is here to answer any difficult questions that may come up in the Q&A. And I'm also delighted I'm joined by Claire Murdoch from the Commission team, who's here to answer the even more difficult questions that may come up in the Q&A. So delighted that both of them have been able to join me. And just what we'll do is, for those of you who've been on our webinars before, we'll follow the same format, and that what we'll do is I'll provide some broad overview comments and show you some pictures from our publication, and then what we'll do is we will open it up for Q&A. For the Q&A, what we'll do is we'll use Slido. So if you're able to click on the link, so scan the link or go to Slido and put in the code, then you'll see the page for our Q&A session, and at that point there's an opportunity for you to put in any questions, and then you can vote for the questions that you'd like to hear us answer, and we'll try to get around as many questions as possible. Just to say that we are recording the webinar today, but the only people being recorded are myself, Domenico, and Claire, and then that will just be so that people can log on and view it. So no one else on the call will be recorded, and any of the questions, etc., will be anonymized as well. So that gives us a chance to share it with a wider group. Yeah, and thanks. You see the code is also, and the link is also gone into the chat as well. Okay, so if we can just dive straight into it. So I just wanted to give you a brief update about where we are in terms of the process. So we are publishing our updated economic and fiscal forecasts today. And the plan had been that these forecasts would accompany the Scottish Government's publication of their medium-term financial strategy. However, the Government have decided to delay that until the 25th of June. We took the decision that because we had done all the analysis and we had the key information that we needed from the Government, that we would publish today. And then we'll publish an update, a small update to our report in June to accompany the medium-term financial strategy. But publishing today gives a chance to talk about some of the key trends and some of the key issues that are emerging from our latest update. Between then and the 25th of June, we obviously have the UK Government Spending Review on the 11th of June. We'll hear more details about the UK Government's plans for public spending across the UK, and that will provide greater clarity around potential future Barnett consequentials as well, and potential BGAs that will have an impact upon the Scottish budget. So that's a key date in the horizon. And then finally, we will be, just to flag, is that we'll be publishing our evaluation report toward the end of August, but also a fiscal update. And people might remember we did that last year, where essentially we did an overview about where things were progressing in terms of the public finances through the current financial year, and talk about any pressures or any opportunities that are emerging in that, just to help set the scene for the pre-budget scrutiny and the preparations of the budget, which will come later on in the year. So that's the various components that we've got over the next few months, so quite a busy period of fiscal updates. So what I wanted to do was just give you a brief overview about some of the core things that we are talking about in our report, and I'll break it down into some discussion about the economy, some tax, social security, and the overall funding position. So in the economy, what we've done as a headline measure is slightly reduce our forecast for this year, ever so slightly, from 1.6% that we're forecasting December to 1.2% today for this current financial year 25-26, before returning to growth of 1.8% in 26-27. And the main reason for that is some weaker data that has emerged toward the tail end of last year and into early this year, but also some of the uncertainty that we see moving around the global economy, around globalization and international trade, and the potential threat of tariffs. We spend a bit of time in the report talking about tariffs and talking about how tariffs might impact upon the Scottish economy. Just to be clear, in our central scenario, we're essentially assuming a largely neutral position, so not a significant increase of tariffs or not a significant change in trading deals. We assume a broadly neutral scenario, which makes us consistent with what the OBR have done at the UK. Our main reason for that, our main judgment for that, was largely the fact that lots of things are still changing with the potential outlook for tariffs. Even today, we obviously have the news from the US about the legal challenge to the tariffs being imposed. So there's a lot happening. There's potential trade deals, the potential retaliation. It's really difficult to land on a particular scenario that we think will be accurate for what is likely to happen over the next few months. So what we do, as I said, is we take a largely neutral approach, but we do highlight about what could happen to the Scottish economy if there are going to be a proliferation of tariffs. Broadly speaking, what we do is we say that if there is to be an increase in tariffs, that will be a downside risk to our growth forecast. What we mean here, though, is not that we see a significant downturn in the Scottish economy or a significant recession. What we're really saying is that we expect growth to be slower than it otherwise would have been. So roughly speaking, we're thinking we would lose, from the scenario we talk about in a report, of around about a third of the growth this year from an escalation of tariffs being imposed. There are lots of uncertainties around that. Of course, it depends a bit upon trade deals, it depends a bit on retaliation and the like, but we're largely taking the view that the imposition of tariffs, at least be short of a full-scale trade war, will largely lead to an easing in growth and a slowdown in that trajectory. We've also done some work to look at whether we think that Scotland is more at risk or less at risk from tariffs compared to the rest of the UK. And our judgment is actually we're pretty much in the same boat. There isn't a bespoke asymmetric risk or challenge for Scotland relative to the rest of the UK. Of course, that is on the basis of a general assessment around tariffs. It's entirely possible that any sort of trade war or imposition of tariffs could have a disproportionate effect on some sectors relative to others. So we saw that a few years ago where spirits and whisky were targeted, and that had a particular challenge here in Scotland. But short of that, we broadly see the effects of tariffs being largely the same in Scotland and the rest of the UK, given the structure of our economies and also who we trade with. So that's a broad overview about the economy overall. One of the things that that we track quite carefully is what's happening to earnings. And the reason we track that is one of the big taxes that we have devolved in Scotland is income tax. And what really matters for our income tax is factors like earnings and employment. So how earnings are doing is something that we take a keen interest in. And as you know, the way that this fiscal framework worked for Scotland and the kind of the net boost to the Scottish budget from tax devolution really depends upon the interaction and the relative performance of Scottish income tax revenues relative to income tax revenues in the rest of the UK. And it's that differential, relative differential, that drives the net tax position, which in turn drives the additional contribution to the Scottish budget. So one of the things that really matters isn't just what's happening to Scottish earnings, it's actually what is happening to UK earnings and therefore that relative differential between the two. And this is a theme which we'll talk a bit more about in some of the results that we see throughout our report, is that broadly speaking, we haven't really changed our forecast for earnings or income tax in Scotland for this year. But what we're seeing is a more optimistic picture across the UK overall. So on the left-hand side here, I've got our forecasts for 25-26, and then the purple side there, I've got the kind of forecasts from the OBR, and you see that the improvement in sentiment and indications at the UK level is actually bringing UK earnings to be more in line with Scottish earnings. And that means that what's going to happen is that relative tax differential, that relative tax boost to the Scottish budget from income tax in Scotland is going to be diminished because of the relative performance of the UK doing better. So it's not so much what's happening in Scotland, it's more about a more positive picture in the rest of the UK. So just moving on to that and just to explaining about what we think is going to happen to the tax revenues in that context. This chart here, just click through to this chart here, just shows you that what's happening to the projected net income tax position in Scotland. So as I said, remember, what matters in the net position is essentially that relative differential between income tax receipts per head in Scotland relative to income tax receipts per head in the rest of the UK. And the fact that it's positive means that through the Scottish Government's policy choices and the performance of the economy, we're adding to the Scottish budget as a result of tax devolution. And we think that that number will be around about 600 million in 25-26. But crucially, what you see is that it's become slightly weaker than where we were thinking it was in December. So we've revised it down by around about 200 million. And the key reason for that isn't that we have really changed our forecast in Scotland. It's that the forecasts for the UK overall have become more optimistic. They become more positive. Earnings are likely to be higher, and that eats into that gap and has made the net tax position slightly less positive for Scotland. One of the other things that we're also seeing is that the data going backwards, so the data that we see in previous years, is also showing that the UK numbers are coming in better than forecast, and actually even better than what was happening in Scotland. So we're likely to see potentially negative reconciliations. So that's where adjustments are made for the fact that forecasts are coming in at lower than outturn. We're likely to see negative reconciliations for the Scottish budget coming in toward some of the later years in the forecast horizon, and that's a challenge that the government will have to manage. So we see this relative slightly weaker performance in terms of the net tax position. We still think it will get slightly positive toward the end of the horizon, in part because of effects like fiscal drag, but that there is a risk still in here that if UK earnings continue to essentially catch up with what we've seen in recent years in Scotland and potentially even perform slightly better, then this net position could actually weaken further over the end of the forecast horizon. One of the other interesting things that we talk about again in the report is this thing called the economic performance gap between the projected numbers that we would think from just a policy only position relative to what would happen, relative to what's happening in reality and how much the government is raising. And what we do in that is essentially say there's two ways the net tax position can improve. One, because the government is changing tax policy to raise revenue, and the other because the performance of the overall economy is doing slightly better than in the rest of the UK. And if that's the case, that's two positive effects that boosts the net tax position. But clearly, they don't always have to be positive. And what we're seeing is that the government's actions are seeking to raise quite a significant amount of additional revenue in Scotland. So on a policy-only position, we estimate in 25-26 that's worth about £1.7 billion. But the reality is we're only seeing around about £600 million projected to come through in terms of outturn. And that gap, therefore, of £1 billion is what we call this kind of economic performance gap. And what's in that economic performance gap, what's driving that? Well, it's essentially everything that is explaining the difference between outturn data, the projected revenue we will get in Scotland, and what would happen if you simply implemented a static policy proposal of changes in income tax. So that includes behavioural change, it includes relative economic performance, it includes sectoral differences, it includes variations in terms of tax profiles in there, and that just essentially highlights one of the big risks that is within the fiscal framework for Scotland, in the sense that it's that relative performance in the economy that is absolutely crucial for determining the net contribution to the budget. I should just say that alongside the fact that the income tax net position is projected to be positive, so adding to the budget, Obviously, the other taxes have a net position as well, and we see them also adding to the Scottish budget. So in particular, LBTT adding about £400 million net to the Scottish budget in the near term. So that's tax, and it's interesting that the change that we've seen in net tax position coming through the improvement in the relative performance of the UK. So that's tax. What about Social Security? So Social Security, if you recall, operates in a kind of a similar way into that conversation we just had around tax, in that what happens is essentially is that the UK government do essentially a fiscal transfer, so a block grant adjustment to the Scottish budget in order for them to essentially deliver comparable benefits on a similar per capita basis as in the rest of the UK. And it's up to the Scottish Government to then decide what they want to do completely autonomously with their own policies. And what we've seen over several years is a deliberate attempt by the Scottish Government to invest significant additional sums of money into Social Security as part of its broader objectives around tackling inequalities and tackling child poverty, which is leading to essentially the spending commitments they are making, running ahead of the equivalent funding that is flowing in here. And we know that from the most recent outturn data, that's getting close to £1 billion, and we think that that gap will increase over the next few years. Why is that gap there? So what are the reasons for that? So there's, broadly speaking, 4 key reasons why spending is running ahead of the funding. So in part, this is explained by payments that simply don't have an equivalent payment in the rest of the UK. So the obvious one is the Scottish Child Payment, which is unique to Scotland. There's some payments where the Scottish Government has been a bit more expansive in terms of its entitlement or its intent or its coverage relative to other parts of the UK. So that's things like the winter fuel payment, which is currently more expansive in Scotland relative to the UK, though that may change depending what the UK Government decide in that. There's a third area where there are payments that the Scottish Government has introduced or expanded to counteract decisions that are taken at the UK level. So the obvious one, the most recent one, is the mitigation of the 2-child limit. So that, again, because it's not funded at the UK level, adds an additional spending pressure in Scotland. And then finally, and perhaps, taking about a significant chunk of this additional element, is the delivery system of Social Security in Scotland. And again, very much this approach in Scotland of taking a more inclusive, a more supportive approach to applying for payments. Once you're on payments, a less intrusive approach to continuation of payments. And that is leading to estimated higher inflows and fewer outflows of people into some key payments. And we see that consistently over time now, and that again adds to the potential spending commitments relative to the overall funding. So we see that gap increasing over time. So the one question is, well, how do we explain the difference between what we were talking about in December? So that's given by that purple line and that green line here. And the real reason for that is actually not specifically decisions taken in Scotland, but it relates to the UK government's decisions that they've announced to try and reduce expenditure, or at least reduce the growth in expenditure on some key benefits, including personal independent payments. And if you think about the way this interacts, if the UK government cut essentially spending on something like personal independent payments, while that is devolved in Scotland, what happens is that the block grant adjustment falls by an equivalent amount, because the whole system is designed on delivering comparable payments to the rest of the UK. So the Scottish Government can continue to spend in a completely different system, just the funding falls. And that essentially explains why we've seen since December quite not an insignificant drop down in the funding gaps, to the point that we think by the end of the forecast period, the funding gap between the funds flowing in for the payment, Social Security payments in Scotland, and how much is being committed will rise to about £2 billion, which again is not an insignificant funding pressure. So just turning to broadly what's happening to the block grants and the overall funding elements. What we've done here is just showed you what's happening to the total funding of the Scottish Government and broken that down into resource funding and capital funding. And a couple of things just to highlight for you. You see quite a significant increase between last year and this financial year. A significant amount of that is what's happening to capital spending through the Barnett Block Grant. You recall we've spoken before about how the current UK government have essentially reversed the immediate cuts that the previous UK government were planning in capital spending, and that's leading to a significant growth in capital spending of nearly 16% into this year. But then what happens is after that spike, it starts to ease off over time. So you've had that one-off level increase, and over time, inflation erodes the real spending power of that. On resource funding, the increases are more modest. So you see this year an increase of about 3% in real terms. That's healthier than what we were forecasting back in December, in part because the Scottish Government have decided to not spend full amounts. They were planning in 2024, 2025, so they just shifted some spend into this year. So that increases the spending this year, decreases spending last year, so improves the growth rate. There's also been some additional UK government funding too. A couple of points about maybe looking forward toward the end of the forecast horizon. You see that we're projecting a relatively weak growth in 2027, 2028 relative to other years. That's largely driven by quite a significant negative income tax reconciliation that we see coming down the line, in part, as I mentioned, because of that significant improvement in UK tax receipts relative to Scottish tax receipts, which means that the net boost to the Scottish Government it was bigger than it otherwise should have been. So that money has to be paid back, and that's why we're seeing a much weaker growth in that year. But then toward the end of the horizon, you're looking at growth rates of between 1% and 2% toward the end of the spending period. A lot of that is going to be determined by what happens in terms of the overall spending review and where the UK government trend on that. So relatively decent growth this year, but relatively fragile growth for the remainder of the forecast horizon. So just turning to some of the kind of funding pressures and some of the challenges in all of this. So I mentioned that we're seeing this negative funding position on Social Security, and that increasing over time. And that's quite a deliberate decision by the Scottish Government, as I said, to invest in tackling poverty and tackling inequality. But what it does mean is that when you operate under a fixed budget, then what happens is that if you operate under a fixed budget, then the amount of additional resource that you have for everything else, it has to be trimmed, has to be reduced in order to pay for that. So you have an additional commitments in one area with a fixed budget. You have to find that money from somewhere else, or you have to cut back on your you have to increase taxation. And that's what we're seeing here. Just to illustrate that, you see that the nominal increase in the resource spending looks relatively healthy, quite a significant increase. Once you account for inflation, that increase obviously eases off quite a lot, and the spending power of that amount of money decreases. But if you see what's happened once you account for Social Security, so essentially what is left for everything else in the budget, so for education, for health, for economic development, you see that is reduced further, because that means that more money is going into Social Security relative to everywhere else has to have slightly less of an increase and a growth. And that, again, is really quite tight. So if you look at that growth there over the 5-year period, you're talking about the amount of resource for day-to-day public spending and public services increasing in total by about 5% in real terms, so around about 1% in real terms per year. That is still really tight. Once you start to think about some of the other big spending pressures that we know exist, whether it be in the NHS, whether it be tackling climate change, etc. So it's going to be a real tight settlement for the next few years. So just to expand a bit before we open it up to questions on what are some of these kind of funding risks or some of the funding pressures that we're highlighting to government to think about, to be aware of. Obviously, we've got the spending review, as I mentioned, on the 11th of June. That will be when we get the real clarity about what the UK government is doing on spend across their responsibilities, which then leads to Barnett consequentials. of course, they've set out the broad parameters for that so far. Once we see the specifics, we'll know the exact allocations to Scotland. Clearly, if there are changes, so if they prioritise devolved areas relative to reserved areas, that will mean more Barnett consequentials. If, on the other hand, they prioritise areas such as defence, which is possible, then that potentially would lead to less generous or less significant Barnett consequentials coming through. So there's a lot of risks in there, and we'll get clarity on that over the next month. On the income tax side of things, I mentioned that we've seen this decline in the relative net tax position recently. There's a potential that could continue, particularly if UK earnings continue to catch up and potentially outperform the position in Scotland. And if we see upward revisions in OBR earnings growth, as it has done for this year, that's going to eat into that net tax position. As I mentioned, we do have this negative reconciliation because of that overall improvement in UK tax revenues projected to come in 2027, 2028. We'll know the exact detail about that next summer, but we're looking at potentially a reconciliation of over £800 million, which is not definitely not insignificant. That's on the funding side. On the spending side, we're seeing some of the old familiar pressures coming through. So public sector pay, again, we've highlighted this as a risk on the spending side to the government's budget. Government's public sector pay policy of 3% this year. We're already seeing pay awards coming in above that, particularly NHS, but also in areas such as ScotRail. So that's ahead of the policy, which then means with a fixed budget, you're going to have to find resources elsewhere. That potentially creates pressure for other pay awards to also come in above the pay policy, which in turn leads to pressure there. So there's a potential risk in there. There's obviously the national insurance increase is now hit, so the government is now paying higher national insurance contributions. The government estimate they've only been funded for between about half and 2/3 of that increase. So again, that's pressures that are now being wrapped up into other areas. And that all gets into questions about what's the future balance of the workforce in the public sector in Scotland. I've mentioned Social Security and the pressures that are there in Social Security. We need to wait and see what happens. The UK government have started to talk about potential other policy changes in Social Security. So some of that on things like winter fuel payments or two-child limit might actually lead to more funding, which would potentially ease at the margin some of this increase. Of course, if they don't follow through in that, then that wouldn't have any impact on the funding element. But equally, if they choose to continue new ideas to potentially cut Social Security spending in the rest of the UK, that may in turn have new negative effects on the funding outlook. So it's a really important thing just to be aware of and watch for, that even though some payments are now devolved to Scotland, the funding of those payments now still heavily depends upon decisions that are taken in the rest of the UK and the UK as a whole. And of course, if you're talking about real terms growth in the resource spending of about 1% a year once you remove Social Security, that obviously brings up big questions about, do we have the fiscal headroom to cope with some of the big challenges that we've talked about more generally in our work around population ageing, around the pressures on the healthcare, the investments needed to hit our net zero objectives, which suggests that actually there isn't going to be a lot of big room additionality of spend to come through to help support additional spending here. So we're going to have to look at much more innovative ways to think about how we can tackle some of these big long-term public spending pressures in a world where fiscal budgets are going to be still exceptionally tight. So with that, what we'll do is I'll just quickly put up the Slido link again for anyone who hasn't got it yet. And what I'll do is I'll stop sharing my slides. These slides will be going on our website, so you can access them afterwards. And I'll stop sharing, and then what we'll do is we'll just jump straight into questions, if that's okay. Great. Okay. Domenico, maybe I can bring you in because I've been talking for a wee while now. There's a question about tariffs and the effect of tariffs on the global economy. And I guess we've talked a bit about tariffs in the US context, but it'd be really good to hear from you about the broader global context on tariffs and some of the scenarios you think might play out over the next few months.
Yeah, sure. Thanks, Graham. So, as you noted in our report, we have not assumed a specific level for U.S. tariffs on the UK, but rather we have incorporated the uncertainty impact that tariffs raise vis-à-vis the UK economy and Scotland, of course. This is also true for the global economy at large. So the first impact of the U.S. tariffs, whether they have been threatened, they've been announced, and then sort of the Trump administration has sort of freezed on the application of those measures, regardless of the actual sort of a legal status of those tariffs. So the first impact is certainly is uncertainty, and this uncertainty is, of course, exerting relevant impact. First of all, in the United States, current forecasts assume that the U.S. growth may slow down this year by almost a percentage point. The impact, though, may vary. In the European Union, the impact of tariffs is estimated in the neighborhood of at least 0.2 percentage points. The impact is much stronger in Canada due to very close, trade relationship with the American neighbor, and of course, a lot will depend on whether countries, big economies, say like China, will be able to export to sort of redeploy their productive capacity towards other markets, say Europe. So all in all, I would say there is substantial uncertainty. Latest news from the US do point to legal challenge that have been moved to the Trump administration. This may sort of galvanize, may strengthen the bargaining power of some negotiating, or some countries that are currently negotiating with the administration. But I think so far the overall impact has been to raise uncertainty, and with that already producing economic impact. Only in the United States, the impact of tariffs, whether it's sort of projected, expected, or actual, has produced a sort of a monetary policy stance that is more restrictive than it would have otherwise been. And it has already produced, as I said, an expected lower level of activity that has been estimated in the tune of close to 1 percentage point. This is to say almost twice the impact that we expect for this year on the Scottish economy.
Yeah, okay, great. Thanks, Domenico. And again, that just highlights, I guess, why what we've done is tried to get a broadly neutral position, but highlight the scale of the risks given on some of the decisions that are taken. Great. So there's a couple of questions I'll try and link. So one was around, could 2026 onwards look different if there's a change in administration, and then what might happen if there was tax policy changes in that and closer like to the UK, would the performance gap still remain? So on the first question about could things look differently from 2026 onwards? So yes is the short answer, in the sense that what we do is that we essentially take government policy as what we model. So clearly, if future governments change, whether that be different colours of government in terms of a new form of government, or whether it be the existing government with new policies, then we would change our modelling to do that. And I guess that depends upon, what goes into manifestos and what happens to the political colour of the governments that are there. So yeah, these projections are all based on current Scottish Government policies, and of course that could change. And the question about, what could happen if tax policy reverted more closely to match the UK. I mean, this is where I think there's a number of different factors going on here. So when we talk about the economic performance gap, excuse me, just to be clear, what we're not saying is that this is a performance gap that is the result of the tax policy changes. What we're doing is essentially saying we have these tax policies, and this is how much they would raise if Scottish economy had performed the same as the UK, and then this is actually what they are raising. So everything else that explains that is into that overall economic performance gap. So one of the things we've seen, for example, in recent times, is that the boost that Scottish tax revenues were getting from the northeast, from oil and gas, for example, has declined in recent years as average salaries in the northeast have fallen or grown less strongly than the overall economy as a result of the downturn in oil and gas, and that is one of the key reasons why we see Scottish tax revenues not performing as well as in the rest of the UK. It's also driven by factors in the rest of the UK as well. So remember, the rest of the UK has London in there. So if London is doing really, really well, that has an impact on our performance gap because they're doing even better than us. So I guess it's one of the real kind of unanswered questions, or the unknown questions, is what happens when you're changing tax policy in terms of the impact on the economy. We've got some evidence from HMRC that suggests that at the margin, for the very small early changes that were implemented, you did have some behavioural change, had an impact on Scottish public finances. But then against that, we've also got data from HMRC that shows actually there's been a net inflow of taxpayers into Scotland, actually, over recent years. So it's a bit of a mixed bag. I think it's too early to say definitively in either way what would happen if you were to change tax policies, what would happen to economic performance. There is new data coming out from HMRC, which should hopefully in time give us and academics more of a chance to look at that, but it's still one of the big unanswered questions. There's a question here about the borrowing limits too small for the Scottish Government. I'll maybe bring Claire in to help expand on this, but so we don't make a comment about whether the borrowing limits are too big or too small as a policy position. But I think one of the things that we see coming down the line is that if there is this big reconciliation in 27-28 of over £800 million, I said that's still uncertain at this stage, but it's a projection, that would exceed the amount of money the Scottish Government could borrow to pay for that. So it would exceed the borrowing limits, and the government would have to essentially make some savings elsewhere. But Claire, maybe we could ask you maybe to expand on that and just talk about the borrowing limits and how that interacts with the reconciliations.
Yeah, so that's related to our income tax reconciliation, which is for resource borrowing. So the government could borrow £600 million in 24-25, and it's been uprated with inflation since then. But in 27-28, we're expecting to see a reconciliation now, which is larger than the borrowing limits. I think we're hoping in a future report to look at how frequently that might happen, because you've seen very large earnings growth in recent years. So you've had big increases in income tax revenues, potentially larger than the growth in the borrowing limits the government has. Whether that's right or not is for others to say, but we can say how frequently the government might exceed those limits. And on the capital side, the government could borrow £450 million in 24-25, and they're planning to use £472 million of capital borrowing in the current financial year. So they are taking full advantage this year. And again, whether that's the right level or not is for others to say, but that's sort of how they're planning on using them. Great,
excellent, thanks. Thanks, Claire. So a question about what are the most impactful policies the government could take to boost economic growth. So this is where the good answer to this, the good out that we have as the Commission is that we don't comment or recommend policies to government. We just take their policies and then model for them. So that's the kind of official answer, and it's our get out of jail free card to answering that really kind of difficult question. But I think on the point of principle, if I can maybe broaden it out, I mean, I think again what you see in our reports are that what's fundamental to the relative performance of Scotland's economy is our productivity performance, relative to the rest of the UK. I mean, we can do things around employment, but we've got relatively high levels of employment, and you can get that even better. Of course you can tackle unemployment, improve activity, but productivity is fundamental to that. And that's back to the usual suspects of skills, of investment, of entrepreneurship, of innovation. These are all the bits that will have a disproportionate impact upon Scotland's relative economic growth. But what's really important, again, just to emphasise, isn't just about how Scotland does, it's how we do relative to the rest of the UK. And that's the bit that really matters within this framework. One thing that also matters from a revenue point of view is how rich that growth is in terms of tax revenues. So again, this is why productivity is really important, because it's about creating high earning jobs. Because if you've got a progressive income tax system, the more you can actually create higher earning jobs, the more you can use Fair Work to create higher earning jobs, the more you can use skills, innovation to create higher earning jobs. That actually leads to more revenues coming through the system because of the nature of that of progressive structure. But there are some challenges in there for Scotland in terms of our sector mix. So there are some parts of our economy where we do really well. So things like energy and financial services are relatively high productive sectors, so therefore high earnings. But if these sectors struggle relative to the rest of the UK, so if we get declines in oil and gas, if these sectors perform less well, then that's going to have less of a positive impact upon our relative economic performance over time, and that's a potential challenge. Dominic, maybe if I come to you just about there's a question about the tariff scenario, but maybe broaden it out, I think, because a broader question which you started to touch on there, I think, which was quite interesting about what we do in the short run is model tariffs in terms of the decline in trade, etc. But clearly one of the risks with tariffs and scaling back globalization is how this impacts upon productivity, investment, supply chain dislocations, etc. Could you maybe just talk through what are the channels that could have an impact on Scotland, and how we might think about how we assess they would work?
Yeah. So first of all, we determined that there is no sort of idiosyncratic risk to the Scottish economy vis-a-vis the rest of the UK. So the Scottish economy is more or less, exposed to the US as much as it is the rest of the United Kingdom. That said, clearly there are some channels of transmission in terms of, the shocks generated by tariffs or uncertainty about tariffs. So first of all, this is sort of dislocation or disruptions of supply chains. So this is true, of course, this could be true of course, for the UK, for other regions, including the US economy, by the way. And the other channels of transmission is, of course, investment. Obviously, if the country I'm invested is unable to export, say, to the United States because there is a very high level of tariffs being imposed, then of course, or if there is only the expectation that a high level of tariffs could be imposed on a given country, of course, it is going to discourage investment. And of course, by that, one of the implications is that also, productivity is going to slow down. If foreign trade as a result of tariffs being imposed or only being threatened slows down, as it is actually the case, what we are already observing in the data, of course, if foreign trade slows down, clearly there's going to be less specialization, and therefore, productivity will also be slowing down. So broadly speaking, these are the channels through which the shocks emanating from the sanctionary, US trade policy regime is going to affect the rest of the global economy.
Great, thanks. Domenico, yeah, and we've seen that, I guess, with Brexit more recently, where you've seen the links between Brexit and then the fall in business investment, and how that then is going to have a long-term impact upon the economy. So there's that immediate effect, but then there's just that slower growth over the long run as productivity is scaled back. So it's a question about secondary effects of increased social security spending, for example, reducing poverty and contributing to the earnings growth. So it's a great question, and this is something we think a lot about. And I think what we do is try and separate out what might happen in the short run and what might happen in the long run. So typically in the short run, what essentially we're doing is, because you've got a fixed budget at the government level, you're essentially kind of moving money around rather than additional spending. So the additional spending that goes into social security from a macro perspective is essentially reduced spending elsewhere, either by government or through higher taxation, and then reduced spending of consumers on that basis. So in the short run, both of the excuse me, both the effects essentially kind of cancel one another out. In the long run, though, this is where it gets really interesting, which is what potentially might be the long-term effects of investment in something like social security. And here, I guess the evidence is still quite light, but it's potentially positive in the sense that if you can actually improve living standards for people, pull more people out of poverty, you can actually then lead to long-term benefit. So in terms of higher rates of employment, potentially healthier lives, which in turn lead to improvements in health outcomes, which in turn lead to less spending in the NHS. And we did a report quite recently looking at long-term trends in health spending, and you see that if we can start to make some savings and improve Scotland's health record, then that can actually lead to significant financial benefits to Scotland from the public finances over time. So I think the question about the secondary effects, I think, is much more of a medium to longer term question rather than something that happens in the immediate term, because in the short term you're really just moving money around. It's actually more about what's the effects of actually reducing poverty rather than actually changing social security spending, because if you can get that bit right, then that can lead to improvements. Of course, the bit we don't know, and I guess the real policy question, is that, you know, what are the best policies to reduce poverty if you've got this balance between, on the one hand, social security, but also having to make savings elsewhere in the budget? How do you continue to invest in housing, in education, in other support that goes into tackling poverty? And that's the real thorny, challenging policy question that policymakers are having to deal with. And then just maybe one final question, come to you, Claire, before my throat gives in, around public service reform and possible implications for resource spending. Maybe if you could talk through what we do around that and some of the principles we adopt around how we essentially assess government policies.
Thanks, Graeme. So I think this is questions around public service reform strategy are probably wrapped up as well in what the government's going to do in its medium-term financial strategy. So on the 25th of June, we're looking to the government to publish what's called the MTFS, and in that they'll set out their 5-year forecast of funding, but also of spending. And then that will show whether there is a gap between funding and spending. And if there is, which in previous years there has been a gap, and spending sort of plans and commitments based on the current trajectory has been higher than funding, there's a gap they have to close in order to balance their budget. And public service reform comes into that. It's part of like, how are they going to do that, and what's the most efficient way of them doing it? And also, you know, the work we've done on fiscal sustainability over 50 years shows that this isn't just a challenge over 5 years, but actually it's going to intensify over the next, you know, few decades. So the government needs to be thinking about how to do that in a way that doesn't just make it sustainable for the next 5 years, but also for the next few decades. In terms of sort of where we're at, we're waiting for the government to publish that information, and we'll be looking at it, and then we'll be providing some commentary alongside the MTFS on the 25th of June. But I think also looking more to our publication at the end of August, when we'll take stock of everything that's happened, because the things in the fiscal world seem to move quite quickly, and where we're at over the summer, and then provide that to Parliament before Parliament returns from its recess at the start of September.
Brilliant. Great, thanks, Claire. So I'm just conscious of time, and I'm sure many people will be jumping off to another Teams or Zoom meeting. So we'll look to end now and give you a few minutes back. But just before we go, first of all, thank you so much for joining us, and thank you to Domenico and Claire for the support in this webinar. Claire mentioned our latest projections on fiscal sustainability, so that was published in April, and do encourage you to have a read of that. We will be doing more work on fiscal sustainability over the coming months, and another report coming out next year. We've got some other publications coming out more over the shorter term. So as I mentioned, we've got an update coming around when the government published their medium-term financial strategy at the end of June. And then we'll be publishing our fiscal update and fiscal evaluation reports in August to help set the scene for the conversations that will take place in the run-up to the budget, which is likely to take place toward the end of the year. So there's quite a lot of work for us, and lots more reports and things to share with you. So thank you so much for joining us, and yeah, hope to see everybody soon. Thank you.